let's talk about the presentations and analysis of property, plant and equipment, along with the mineral resources on the financial statements. This is our last discussion for this chapter, and will take quite long durations. Okay. For depreciating assets like building, machinery, and equipment, the company uses an accumulated depreciations account. Okay, you are familiar with this account. This account offsets the assets cost on the balance sheet or financial position, showing the cumulative amount of depreciation expense that has been recognized over the assets' useful life. On the other hand, depleting assets such as mineral resources may be presented in one of the two ways here. Some companies use an accumulated depletions account to show the reductions in value as the resource is extracted. Alternatively, the depletions may be recorded through direct reductions of the assets carrying amount on the balance sheet. In addition to these presentations, there are some essential disclosures required for transparency. So, the company needs to disclose these informations in their notes. Company should disclose the basis of valuations, which is usually the cost of assets. This helps stakeholders understand the methods used to assign value to the assets. Companies should also disclose any pledge, liens, or other commitments associated with these assets. And this information is crucial for understanding any legal claims on the assets or obligations tied to them. Let's finish by looking at the important financial ratio used to analyze the efficiency of a company use of assets, the asset turnover. This is the first ratio that we are going to cover. This ratio measures how effectively a company uses its assets to generate sales revenue. A higher asset turnover ratio indicates more efficient use of assets. The higher, the better. Okay, because the higher the asset turnover ratio, that will means the company use the asset more efficiently. Here the example with the data from Adidas AG. Net sales for the year were 14,000 something here. Total asset at the end of 2012, 11 million, and total asset of the at the end of 2011 we have quite similar amount, 11,000. And we have net income as well, 500 something. To calculate the asset turnover ratio, we use this formula: asset turnover equal to net sales divided by average total assets. First, we find the average total asset. Okay, the average total assets, we will calculate the average total asset by adding up the ending balance of the asset and the beginning balance of the asset and the ending balance divided by 2. That it gives us 11,000 something, 11,400 something, and then in obtaining the asset turnover, we apply to the formula net assets divided by the average total assets. It gives us 1.3. This means for every euro of asset, Adidas generated approximately 1.3 in sales. This ratio provides a quick look at how effectively Adidas is using its assets to drive revenue. Analysts and investors can use this information to compare the company's efficiency over time or against competitors in the same industry. Okay, so basically, asset turnover is the ability of the asset in generating sales. Next, let's look at another important financial metric, which is the profit margin on sales. This ratio measures a company's ability to generate operating income from a given level of sales. In other words, it shows how much company can make profit for each euro of sales. For this example, we will again use the data from Adidas AG. Net sales were 14 million something, total assets still the same figure, total assets at the beginning period, at the ending period, and we have net income of 500 something. The formula we will use is profit margin on sales equal to net income divided by net sales. Applying the figures from the data, we will have the profit margin on sales of 3.5%. This figure tells us that Adidas earned about 3.5 cents of profit for each euro of sales during the period. The profit margin on sales is helpful for assessing a company's efficiency in controlling costs relative to sales. A higher profit margin indicates that more income is retained per unit of sales, which is beneficial for long-term profitability and growth. Analysts use this metric to compare companies within the same industry, okay, to make the financial decisions. Another metric or another indicator here, we will have return on assets or ROA. This ratio measures how effectively firms or company uses its assets to generate earnings. ROA or return on asset is useful for assessing a company's efficiency and profitability in relation to its total assets. And for this example, we still use the same example of Adidas AG here. The net income is 540 and 24. Total asset at the end, total asset at the beginning, and to calculate the return on asset, we will use the formula of net income divided by average total asset. Average total asset we calculated from our previous slides. The beginning plus ending divided by 2. So applying those data into the formula, it will give us 4.6%. What does it mean by having 4.6%? This indicates that Adidas earned about 4.6% in profit for every euro invested in assets. ROI is important because it reflects the company's ability to turn its investment in asset into profits. Okay, of course, investor or analysts will concern on this data. Okay, to gain a deeper understanding on the return on asset, analysts often break it down to two key components: the profit margin on sales and asset turnover. We know already the what we call the formula of each component here. This breakdown helps us to clarify what drives a company ROA, whether it is due to strong profitability or efficient use of asset or combination of both. As you see from the slide here, this is the formula of ROE, how ROE can be disaggregated. So the rate of return on asset, ROE, equals to net income divided by average total asset, as we see from our previous slide. If you can see from this slide, if we rewrite this formula by breaking down into two parts, the margin on sales, profit margin on sales, and asset turnover. The rate of return on assets equals to net income per net sales. It is the profit margin on sales times net sales per average total asset. It is the asset turnover. Okay, so the first part here we have the profit margin on sales with the formula of net income divided by net sales, and the second component is asset turnover with the formula of net sales divided by average total asset. By multiplying these two ratio, we get the overall ROE, profit margin on sales times asset turnover. These aggregations allows us to see if a company's ROA is driven by high profitability, or what we call profit margin on sales, or efficient use of asset to maximize sales, or ideally, in the ideal situations, by combination of both profit margin on sales and asset turnover. By examining the ROA in this way, analysts can better assess whether a company excels or where there may be room for improvement in its operations and financial strategies. So it is crucial for the analyst to assess the ROA of the company. Okay, let's take a closer look at how we can break down the return on assets for deeper insights. We have already discussed the ROA can be disaggregated into two components, the profit margin on sales and asset turnover ratio. And this slide demonstrates how these calculations work together. For Adidas AG, here is how each component of the ROA is calculated. Profit margin on sales, it is from net income divided by net sales. It gives us 3.5%, while for the asset turnover, we have net sales divided by average total of asset, which gives us 1.3. We obtain everything here actually from our previous slides, but this is just to give you to demonstrate how this ROA can be driven by two factors. Now, by multiplying these two components, we will obtain the overall ROA. So this 3.5% times 1.3, it gives us 4.6% of ROA. Okay, and it gives us the same amount with what we have calculated from our previous slide, which is the asset turnover, we got it, and ROA, we got ROA here of 4.6%. So applying the same formula, it gives us the same amount of 4.6% for ROA. Okay, so that's all. This ends our discussions for I know we cover a lot of things with this chapter 11. Starts from depreciations, and then we have depletions, we have impairments, revaluations, and last thing we have this presentation analysis. hope you can recall everything for the sake of your career in the future, and of course for your examinations.